Sell in May and go away. Is that really what you should be doing? Let's find out. Welcome, my friends, to the Iron Gate Global Advisors May Market Commentary. My name is Brett Pattison. I am a portfolio manager and investment advisor at Iron Gate Global Advisors. I thank you for taking a few minutes of your day to listen in to what I think will be a very valuable information. Here's the agenda that we're going to run through here. The first thing that we're going to discuss, as we always do on these commentaries, is a quick review of what happened the prior month and what has happened so far this year. So we'll take a look at that. We also discuss, as we've mentioned, the idea of selling in May and dissect whether that's really a good idea. You've heard the phrase, and it's been uttered all over the TV this morning, the first day of May. People making fun of it, people actually really thinking it's what you should do. So we'll dissect it, and I'll give you some ideas as far as what we are going to be doing and what you can consider on your end. So we'll take a look at that. We'll also take a look at, in regards to May, sector rotation, the importance of sector rotation, and my favorite topic, the role of options in a portfolio. Now, you'll notice something about the chicken to your right-hand side, and that chicken is wearing something very special today. That's our sweet chicken. And he is wearing an official Iron Gate Global t-shirt, which is a pretty darn good-looking t-shirt if I say myself. And the thing about that t-shirt is, at the very end of this few-minute webcast, I'll share with you how you can get your own free Iron Gate t-shirt. So stick around for that. It's very, very easy, and I would love you to have your own t-shirt. So stick around for that. All right, so let's recap April. It was a glorious month. Springtime is one of my favorite times of the year. That's a beautiful picture. You can see, and it was a very flowery type of month, if you want to say so, if you want to call it that. So what happened? Let's take a quick look at the chart to determine what happened. I'm just going to box. That's simply just a box around the month of April. And you can see this is the S&P 500. You can see how we performed in April visually. A lot of visual people. There's the visual behind it. So what do the returns look like? Well, here's the global markets. The U.S. had a 1.49 return in April, the developed non-U.S. 3.05, and the emerging markets, which led everything behind China, which is in fuego right now, was up 5.61%. All right, so that was April. And our clients know that they can see the changes we make in their portfolio. And obviously I can't go into detail because those listening aren't, some are clients, some are not. So I'm not going to go into detail as to how those portfolios look. But certainly we've been able to capitalize on some of that emerging market behavior and develop non-U.S., as we talked about in the April commentary, right? So here's your 2015 return so far. The S&P right around 1.5%, developed non-U.S. around 9.5%, and emerging markets up 9.21%. China, just so everybody's aware, China, of that 9.21%, for the emerging markets, China's up 24.3% this year and has really just been crushing other countries, kind of bigger countries. And so interesting returns, and we're starting to see, as we talked about back in February, we're starting to see that flight to global investments, which is important, all right, in which hopefully you've been able to tilt your portfolio to take advantage of that. All right, so let's take a look at the sectors for the month of April. And I'm not going to go through every sector. I'm just going to highlight a few things. Now, typically in April, you're seeing, consumer discretionary outperform. You're seeing industrials outperform. But what we really saw was a real big bounce in energy, right? Some value investors scooping up some energy names. And that's a complex sector. And I don't pretend to know everything about the energy sector. But what I do know is that it led in April, right, as far as sector returns. The utility sector and interest rate sensitive sector lagged everything else for April. Now, as far as year-to-date returns, you can see that healthcare continues to perform very well. Also, at the very top row, you'll notice consumer discretionary, which a lot of our portfolios are overweight. Also came in second or third place behind energy, but performed really well. The laggard utilities, again, interest rate sensitive sector, more defensive in name, or defensive sector, defensive companies, didn't perform well at all, right? So that's your sector review. And the last couple months, or really the last 6 months, we've been overweight two sectors, and that's been mainly consumer discretionary, which has worked. We've also been overweight industrials, which is down on the year 1.66%. One of the few sectors, or one of the four sectors that's been down for the year. So, typically that does outperform, and I'll show you why we say that just based on history. But also our clients will know that our portfolios are not just based on sectors, but we are value investors, and we have one of the best stock pickers that I've seen in Brian Hunsaker that's leading the charge with picking those stocks, and certainly that has helped overcome those sectors, specifically industrials, which hasn't performed as we had hoped. But our clients, nonetheless, I'm sure, are happy with what's happening. And again, can't go into the detail on this webcast as to any of those stock picks that we have, because those are for our clients, all right? But that is a look at how the year is going as far as sectors go. So let's address the question now that we've reviewed April. Let's address the question of selling in May and going away, or selling in May and pulling your boat out of the ocean and putting your investments on the beach and really just letting the market do its thing, right? So is that what we should be doing? Let's take a look. Let's take a look at history for a moment. As you all know, I'm a huge history guy. I like studying the market history. And November through April, which is the 6 months we just finished, at the very bottom, the bottom row on that slide, you'll see the S&P 500 average return back to 1950s, even before that if you want to do the studies. But the S&P 500 is on average about 7%. Well, the leading sectors are consumer discretionary, industrials, and materials, although the probabilities of it outperforming aren't as good as industrials. But nonetheless, those are your historical returns. And so when you get to that May period, and the question, sell in May and go away. Well, I say no. I say this. I say it's simple. You sell in May and you reallocate your money. And what do I mean by that? Well, let's take a look at history. Here is on the right-hand side, you'll see the column from May through October, average percent returns. And there's the market at the very bottom averages 1%. That's why that phrase exists, right? Sell in May and go away, because you can put money in cash, you can put money in fixed income products and do better than 1%. And that's arguably, that people can argue that. But what you can't argue is this. History has taught us that these defensive names, these defensive sectors, mainly healthcare and consumer staples, have outperformed the market. Healthcare at 4.7%, consumer staples at 4.6%. So when we talk about reallocating, that's what we're meaning, and do the research on your own, especially if you're managing your own money. Those clients, you've seen a shift already. And again, can't go into details, but you've seen that shift take place. And so we are reallocating. That doesn't mean we're selling our stocks that are, consumer discretionary in nature, or information technology, or anything like that, or financials. We're not selling those stocks because that's part of our all-cap value portfolio, but we're the sector, the ETF portion of the accounts that we manage, that shift has occurred. All right, so here's the other thing regarding the sell in May and go away that you can do. And this is what excites me, especially excites me that we can do this for our clients. And it's very simple, right? We have a lot of tools in our tool belt. And one of those tools is a tool that is my expertise, and that's options. And so what do we do in May? Well, we sell what's called out of the money call verticals. Another name for that is bear call spreads. If we know the market's going to kind of go up and down, but not a whole lot, right? And average that 1%, then we can take advantage of the weakness of the market by selling out of the money call spreads, also known as bear call spreads. So how do we do it? Okay, quick summary, and there's a whole lot more information on the education tab of our website. But real quick summary as to how this works. The goal is very simple. Sell out of the money junk and make money for it. That's the goal. Now, that goal doesn't always happen perfectly, and there is risk. And if you don't know anything about options, you just simply don't do the spread or don't trade options until you know what it's all about. All right? There's risks involved. But that's to put the goal as simply as I can. That's it. Sell out of the money junk and make money for it. So what do I mean by that? I've got a chart over here on in the middle right-hand side of your screen. And that's a chart of the S&P 500. All right? And I'm going to use that chart. You can see 1225, maybe a resistance level. 1275 is where the chart ends, far right side. But let's look at this for a second. Here's what the spread is. If I sell a 1250 call on that chart, and let's say it's August time frame, so the market is fluctuating between 1125, 1175, even up to 1225, all right? If I sell a 1250 call, certainly that's out of the money. And I sell that for $2, right? That's a high probability option that I'm selling with, roughly maybe what we shoot for is about an 85% probability that option expires worthless and I make my money, right? So I sell that 1250 call for, say, $2 just to make the math simple. Well, if I don't buy another call, then I'm what's called naked, and naked is very scary, right? So I have to, in order to manage my risk appropriately, I have to buy a 1260 call. $10 wide, you sell that for $1. Again, just keeping the numbers simple. You sell that for $1, and your total credit or total investment can be $1 per contract, $100 per contract rather, $1 per share, or $100 is options trade in 100 shares per contract. That's how much I can make. So if you sell just a bunch of spreads, while the market does really very little, you have the ability to make money. And so here would be your line in the sand. As long as the market stays below that line, you're going to make your money. And again, why would you do this in May? Because in May, June, July, August, because the market simply just historically doesn't move all that much, right? Up and down and up and down and up and down. Returns of 1% on average. And so that's why you do it. You sell that out of the money junk. And then you buy it back. You buy those spreads back when the market sells off, right? That total credit of $1, maybe you buy back that spread at 90 cents and you make 90% of your potential gain, right? And so there's a lot more to it, but that's the idea, the basic premise. Now, I've got, again, a lot more information on short call vertical spreads and bear call spreads on the education tab of our website. And certainly, if you have any questions, you can reach out. But that's a strategy that we're going to be implementing for our clients. And very few, I will tell you, advisors do this type of thing. I went around the country for a long time, for a couple years, teaching advisors how to do this. And very few know how to do it, even less actually do it, right? So talk about a sophisticated trade for our clients for not a whole lot, as far as fees go. I'm happy that we can do this for our clients at a very cheap rate. I'll say that, all right? So here's another example of what those spreads would look like. You'd sell a short call vertical spread out of the money. You'd sell another short call vertical spread out of the money, above the market. You'd sell another one. And this is just an idea as to how we would do this, and another one, right? And so you sell out of the money junk above the market, knowing the market typically doesn't do all that well, and you are paid to do it. And that does a couple things. That enhances our returns, turns that 1% on average as far as the market goes to maybe 2.5%, 3%, right? And that's if things work out perfect. There is risk involved with this. Don't get me wrong. There's always risk, but that's the goal of the spread. Okay? Sell out of the money junk above the market like you see there. So that's the couple things that you can do in May. Reallocate and start implementing options and selling out of the money junk above the market. Those are the two things that you can do as we begin that more defensive time of year, May through October. All right, so this is what we discussed in this brief few minutes together. We discussed April year-to-date and year-to-date returns. We talked about sell in May and do what? Well, we know what, right? Those two things. Talked about sector rotation and, of course, the role of options. So as far as the education tab, which I mentioned, and then I'll get to the sweet chicken shirt, the Education Center, which we're constantly building and working on because an educated client, an educated individual is very important to us, and it should be a goal of yours so that you're not blind as to what I'm doing for you as your advisor, if I am your advisor, or what to do on your own or what your advisor's doing, right? Education's important. So here's my contact information. Brett Pattison, Brett at IGGA.com is my email. My phone number, 888-591-0334. You can see how to connect with me on Twitter and Facebook. And this is how you get your sweet chicken shirt. I would love more people to like our Facebook page. You can see it right there, facebook.com/IronGate Global Advisors. If you like our website, our Facebook page, email me. Like it, then email me. You've got my email right there, Brett at IGGA.com, and I'll send you a t-shirt. Or if you have already liked our Facebook page, share that page with others. They like it. Boom, I send you a t-shirt. All right? Again, you've got to email me at brett@igga.com. I want to send out as many t-shirts as I can because I think we have something to share and something to offer that very few do. And I want to get the word out, right? So get your free IGGA t-shirts. Say they're good looking. It's not your standard crappy looking t-shirt. Those are actually good looking. Anyway, folks, thanks for listening. We will talk to you in in June. Reach out with any questions. Brett at IGGA.com. See ya.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact IronGate Global Advisors at info@igga.com or by calling 888-591-0334.